Welcome back to the Deep Dive, where we take those huge, complex concepts that are always flooding your social media feeds, clear out all the noise, and figure out what's actually true. And today, we are tackling a huge one, a phrase that basically defines the modern internet economy: passive income. I mean, this idea of making money while you sleep has been bubbling up for years, promising true financial freedom, but lately it has just absolutely exploded.
It's everywhere.
It is. We're seeing these constant, meticulously curated screenshots of striped dashboards, flawless real estate portfolios, people claiming six-figure wealth while barely lifting a finger.
And that emotional pull is it's undeniable. It's the ultimate financial fantasy, isn't it?
Yeah.
The reward without the ongoing effort. That's the entire sales pitch. It's designed to draw you in.
Right.
Okay, so let's really unpack this. Welcome to Everything You Need to Know About Finance.
Yes.
We've been doing a really thorough deep dive into some extensive research that,
Yeah.
well, it strongly suggests the entire premise of passive income, at least as it's marketed, is mostly a myth.
A myth designed to sell courses.
Pretty much. So we're here to explore the practical, maybe gritty reality of how lasting wealth is actually built.
That is the mission. We're taking a shovel to this idea and digging deep into the data to find the bedrock truth. Now, just to be absolutely clear here,
Yep.
this discussion is strictly a deep dive into the research we've reviewed. It is not financial advice. We're here to inform your understanding, not to instruct your portfolio choices. And if you find these kinds of deep dives interesting, please just take a moment to like and subscribe. It's honestly the best way to help us keep digging into these massive topics so you don't have to.
Okay, so where do we start?
Let's start with the root of the problem, because the analysis we looked at is very, very specific about this. Passive income is almost entirely a marketing issue.
Absolutely. The research suggests that social media, those YouTube tutorials, the extensive courses, they're all designed exclusively to show you the outcome,
The finished product.
the finished product. It's the money hitting the account while the guru is, on a beach somewhere. That's what sells the dream.
But what's systematically hidden from view, I mean, every piece of information we looked at is crystal clear on this.
Yeah.
What you don't see are the years of focused, non-paid work, the significant upfront capital that was required, the multiple business failures that happen behind the scenes.
Or the constant ongoing maintenance that's needed just to keep that money flowing.
Right.
And this is the key insight we have to carry forward. When you see a passive income stream, you are virtually always seeing it at the end of the journey, never the beginning.
That's a great analogy. It's like looking at a finished skyscraper and just completely forgetting about the years of labor it took to secure the land, pour the foundation, all of that.
Exactly. The active part is invisible.
So if the marketing definition is misleading, we need an uncomfortable truth to replace it. What's the honest, unpopular definition of passive income that this research demands we adopt?
The honest definition acknowledges a key distinction. Passive income is income, where your time is not directly traded for each dollar. You aren't invoicing per hour. But, and this is a huge but, it does not mean the effort disappears. It just means the effort is channeled into building reliable capital or established operational systems or setting up some complex oversight.
The analysis breaks this down into 3 inputs needed for any kind of wealth, which I think immediately busts the free money myth.
Right.
In the real world, you only have 3 inputs to generate wealth: time, capital, and risk.
That's the core of it. If you decide you're not going to use your time, if you want that passive component, you're automatically forced to maximize your use of the other 2.
Capital and risk.
Capital and risk. The research confirms there's just no scenario, short of an inheritance or winning the lottery, where the input is 0. If you don't have time to put in, you must have capital. And if you have neither, well, you're likely just maximizing your risk.
Okay, so since those are all intertwined, let's apply that truth to the common examples, the big 3, that are always marketed as fully passive.
Let's do it. You can start with the most classic one. Dividends from stock ownership. The assumption is so elegant, right? You buy a stock, you get paid every quarter, no active work required.
It sounds effortless, but the reality bites when you look at the scale required for this to actually matter.
It really does.
The research highlights you need genuinely enormous capital just to generate a modest income stream. For example, if you want, say, $40,000 a year, and you assume a healthy 3% dividend yield, you need over $1.3 million invested.
And that amount connects directly back to that capital input we just talked about. That capital had to be actively earned or actively saved or maybe even actively borrowed. It doesn't just appear.
And the risk is still there.
The risk is always churning. You face the constant threat of dividend cuts if a company struggles, and then there's the silent killer, inflation, which is always eating away at the purchasing power of your income.
But hold on. A lot of very successful, very wealthy people point to dividend income as the ultimate goal. Is the research saying they're misleading us? Or is there a nuance we're missing?
That's an excellent point. And no, it's not saying they're misleading. It's clarifying the role of that income. The truth about dividends is that they are only truly passive after you've already done all the active work.
After you've built up the capital.
Exactly. After you have successfully generated, saved, and invested that massive amount of capital in the first place. Dividend income isn't a starting line for wealth. It's a consequence of already having it.
Okay, that makes sense. Let's move to myth number 2. Real estate rentals. The pitch is perfect. Tenants pay the mortgage, you build equity.
Yeah, and the data is just blunt on this one. Real estate is fundamentally a business, and often it's a small, incredibly time-intensive one.
The front-loaded labor is intense. Finding deals, due diligence, securing financing. None of that is passive.
Not even close.
Yeah.
And the work doesn't stop there. Think about the operational side. You've got repairs, screening tenants, chasing late payments, dealing with legal stuff, vacancies, taxes.
The research we reviewed cited that self-managing landlords spend, on average, something like 10 to 15 hours a month per property.
Yeah.
That's a part-time job. That's active.
It is absolutely active.
Yeah.
And the natural response is, well, just hire a property manager, which you can do.
Right.
But that just converts your time input into a capital input. You're paying someone else, often 8 to 12% of the rent, to do the active labor you don't want to, so your returns go down.
The core truth remains, it's a business.
It's a labor-leveraged business, not a money machine that runs itself.
Okay, so finally, let's tackle the modern darling of this whole space, online businesses. Courses, ebooks, apps, automated content.
Right. The promise is so intoxicating. Build it once, sell it forever. Here, the critical input is intense, front-loaded labor, and frankly, significant risk. Building a high-quality asset like a comprehensive course or a piece of software that can take months or even years of dedicated non-paid work.
You're trading all your current time for a very uncertain future reward.
Exactly. And crucially, the work absolutely does not stop at launch. The reality is, marketing is constant.
The algorithms are always changing.
They're always changing. Google, YouTube, Meta. You have to be constantly adjusting your strategy. And then you have customer support, technical issues, updates, maintenance.
So even with something like a subscription service, a SaaS app where the system handles the transaction automatically.
Right. The transaction itself feels passive, but the underlying system is not. If you step away for 6 months, I promise you, your competitors will iterate faster, your software will get outdated, and the whole system will just atrophy.
So the money you make tonight is only possible because of the work you did last year and the work you're planning for next week.
Precisely. This is an asset that maximizes that risk input because that initial time investment has zero guarantee of a return.
This analysis brings us perfectly to the next idea, which is about abandoning these misleading labels. If active versus passive is a flawed binary, what's a better way to think about it?
We have to stop thinking of it as an on-off switch. The data suggests it's much more useful to view all income on a fluid spectrum of activity.
A spectrum based on how much of your personal time is required?
Exactly. At one end, you have fully active, that's your salary, your hourly wage, freelancing, where you are directly trading time for every single dollar.
High engagement, zero scalability.
Right. Then moving along, you find semi-active income. Think of a consultant who can charge premium rates or a small business owner with a small team. There's still high time input, but you're starting to leverage other things.
Then you get to system-based income. This is where the systems are doing most of the heavy lifting. Large real estate portfolios with full management teams or that SaaS model we just talked about.
The input there is mostly capital and oversight, not your daily time.
And then finally, at the far end of the spectrum,
You reach capital-dominant income. Bonds, index funds, large diversified investment accounts. Here, the vast majority of income comes purely from the size and compounding power of your capital, not the hours you put in.
I think this shift is transformative for anyone listening. The goal isn't passive income, that's the fantasy. The real achievable goal is generating income that requires less of your time over time.
It's a decades-long sliding scale, not an immediate switch you can flip.
And that clarity leads us right to the actual formula for wealth building that the analysis lays out, and it requires logic, patience, and a total acceptance of effort.
The formula starts with a non-negotiable step. Step 1, active income first.
You can't skip this.
You cannot skip it. You have to focus intensely on maximizing your active earning potential. That means a job, a business, a skill that lets you maximize your savings rate and build value. It is the generator of your capital.
That initial effort then leads directly to step 2. Convert active income into assets. This is where the long-term magic happens.
You have to aggressively use that saved money, your capital, to acquire genuine income-generating assets. We're talking index funds, real estate, businesses. And critically, especially early on, you reinvest everything.
Everything.
Every single penny goes back into the asset base.
And only after those assets start producing real significant cash flow do you reach step 3.
Right. Step 3 is reduce dependence on time. This is where you implement high-level automation, strategic delegation, diversification. This is the stage where the income finally starts to feel passive.
But it's only possible because of the, decade or 2 of active, intentional work that came before it.
Exactly. So what does this all mean for you? Wealth isn't a product you can just buy off the shelf. It's a process. It's built through consistent effort, leverage, and robust systems.
Which brings us to our final segment, and this is the emotional part. Why is this passive income myth so fundamentally dangerous?
Well, the analysis highlights a few emotional tolls. First, the myth creates these profoundly unrealistic expectations.
Right. People start a business or buy a rental and they expect passive results in 3 months because that's what the marketing promised.
When those results don't materialize, because it always requires more capital or more labor, they quit too early. They destroy what could have been a successful long-term venture.
Or worse.
Or worse, that yearning for zero-effort money makes people incredibly vulnerable to scams, where they happily pay cash for a model that promises the impossible and, of course, delivers nothing.
And I think ultimately the myth just fundamentally undervalues real necessary work. It makes people feel like they're lazy or failures, when in reality they were just misled about the timeline and the effort required.
That's a great point. The research suggests most people aren't lazy. They're just confused about where to apply their energy.
So we want to replace that toxic phrase with actionable, honest questions, a better mindset.
Yeah.
So instead of asking, how do I make passive income? Shift your focus. Start asking, how do I build assets that compound?
Compounding. That's the engine of wealth. It requires consistency and patience, not luck.
Instead of seeking ease, ask the harder but crucial question. How do I increase my leverage?
Leverage, meaning using capital, technology, or systems to amplify your output far beyond what your own hourly labor could ever achieve.
And finally, the most meaningful question of all. How do I buy back my time over the next 10 to 20 years?
That is the real definition of financial freedom. Using intentional action now to reduce your time dependence later.
So that brings us to our final summary. The core learning here feels inescapable. Passive income isn't a starting point. It's a side effect of doing hard, active things consistently for a very long time.
It is the reward for successful active income conversion and system building. Nothing more, nothing less. Moving forward, the whole conversation around financial growth really needs to pivot.
Away from the hacks.
Away from the quick passive hacks, and more towards asset conversion, smart automation, and building durable leverage that lets your capital, not your time, do the heavy lifting.
Okay, so give us the final provocative thought to take away.
Here it is. If someone promises you money with no effort required from you, the effort is almost always yours. It's just being directed in the wrong way. That effort might be wasted on some unsustainable model, or, more likely, it's being directed straight into their pockets.
Wise words to finish on. Thank you for taking this deep dive with us today. If you enjoyed unpacking this massive financial myth, we have plenty more deep dives on complex topics waiting for you. Try out our latest episodes next. We'll catch you next time.